this is Alisha Lalji, and it is my pleasure to introduce to you Mr. Aakash Manghani. Welcome, Mr. Aakash.
Thank you, Arisha. Thank you for having me here. Hope to have an insightful discussion on your podcast.
Introducing to you, Mr. Aakash Manghani has worked as an analyst and fund manager for asset management firms and insurance companies. He is a mid and small cap specialist and thrives in identifying gorilla stocks. Aakash is a co-fund manager for TRUSTMF Multi Cap Fund along with Mr. Mihir. So, Mr. Aakash, my first question to you today is, in the current market setup, what's your view on valuations across market caps today, and do you think the market is fairly priced or running ahead of fundamentals?
Okay, good question to start with. A rather tough one, I would say, because everybody's grappling with where we are. So let's just step back and understand how we got here, right? So the last 5 years have been excellent for earnings growth, have been excellent for stock market returns. Between FY20 to FY25, earnings for broader markets, which is NSE 500 pool of companies, have compounded about 30% CAGR. Interestingly, stock market returns for NSE 500 pool of stocks have also been pretty high at about 23-24% CAGR. So markets have not really run ahead of themselves. Although it looks like we've been in a tearaway bull market, however, markets have just reacted to earnings over the last 5 years. If you look at a slightly longer term picture over the last 10 years, between FY15 to FY25, earnings for NSE 500 companies have compounded about 13 to 14%, and the stock market CAGR has also been 14%. So at a broader market level, we just reacted to earnings growth. And historically, if you go back 10, 15, 20 years over the really long term, market compounding has been in sync with earnings compounding. Where has been the bit of a disconnect is in the small cap and the micro cap universe of stocks, we've had a runaway rally, specifically in the last, I would say, 3 odd years. And there was a lot of euphoria building up in specifically the micro cap, SME, and the small cap segment of the market. And we've been cautioning investors over the last 12, 24 months that look, there is a lot of euphoria. A lot of the companies went up 3x, 4x, 5x in some cases without a lot of earnings support. There was a lot of narrative driven investing that was at play in the last, I would say, 2 odd years. And one good thing happened is that market has seen somewhat of a correction in the last, I would say, 5 to 6 months. A lot of the froth, a lot of the euphoria in the market has gotten corrected, thankfully. And in the last 1 year, if you look at the returns of large cap, mid cap, and small cap universe, they've been low single digit, between 3 to 5%. So markets have taken a breather. At the same time, earnings have also been a bit patchy, specifically in the last, I would say, 2 to 3 quarters. So markets typically have reacted to earnings. There's been a macro slowdown. There's been a cyclical slowdown that our country has witnessed. Markets work on rate of change and forward expectations. So sitting here in mid-June, I think the forward expectations for earnings growth over the next, I would say, 2 to 3 years is fairly decent, which is early double digits to mid double digits, even higher for mid and small cap universe. Given that backdrop, valuations are not too frothy, neither are valuations cheap. I would say in the large cap universe, which is Nifty 50 or Nifty 100, valuations are at mean levels, right? So that's a safe haven from a margin of safety perspective. When you come to mid and small cap universe, mid cap earnings are expected to grow in the vicinity of 14-15% over the next 1 to 2 years. Small cap is between 12-13%. But it's not about the index in mid and small cap. It's highly stock specific. It's identifying the right themes to bet on, identifying the right promoters, the right business models which can sort of scale up over the next couple of years. So you cannot always look at aggregates. They can be deceiving. So we focus on something called as PEG ratio of companies, where we look at not only the earnings growth going forward, but also what is the commensurate PEG. So, for example, a 50 PE stock may actually be cheaper than a 15 or 20 PE stock. If the 50 PE stock can compound earnings at 30 to 40%, the PEG of that stock will be, in the vicinity of 1.3, 1.5. A 20 PE stock, if it finds it difficult to even compound earnings at 5 to 10%, may end up being cheaper. So we don't look at optically cheap, right? So I think to summarize, investors need to moderate return expectations. A lot of people have come into the market in the last 4 to 5 years, and people want this instant gratification. Markets don't work like that. You need to give it a lot of time in the market. Next 2 to 3 years would be more of, early double digit to sort of high single digit return across large cap and mid caps. Could be slightly higher for small caps.
I think that's very well explained, and I like the word that you use when you say froth. I think it explains so much more. So that's very well put. My next question to you is, you have a multi-cap NFO which is around the corner.
Yes.
So what would you like to say to the investors? What should they know more about this?
So look, let's just step back. When we started the organization about 14, 15 months back, we started off with FlexiCap because that's a pretty good approach for a new investor to get in. The fund manager has discretion to go across market caps, large, mid, or small. We followed it up with a small cap fund in the month of November. We were most bullish on that part of the market because we thought most of the emerging themes in the country were available primarily in the small cap universe and some of them in the mid cap. So the earnings compounding in that universe over 3 to 5 years was one of the highest. Now we're getting to a multi-cap offering to investors. What we've realized is that, and we looked at data over the last 10, 15, 20 years, a balanced approach to investing, wherein an investor gets exposure across large cap, mid cap, and small cap, is a pretty decent approach to have. What it does is that it removes a lot of inherent biases that even we as professional investors have. Many a times we become extremely pessimistic of a certain section of the market because of poor earnings growth or exuberance or hype or whatever you may have it. And in the bargain, we completely ignore that segment. So for example, a lot of people in the mutual fund industry have been negative on small caps for the last 12 to 18 months. However, some of the biggest multi-baggers have emerged out of the small cap universe. Stocks have gone up 2x, 3x, 5x only in the last 12 to 18 months. So it pays to sort of pay attention to all segments of the market. There is healthy earnings compounding in each section of the market. Small cap being the highest, followed by mid cap, followed by large cap. Also, a balanced approach minimizes the volatility for the investor. So interestingly, if I look at data over the last 3 years and 5 years, the multi-cap index has given investors significantly higher returns than the large cap index, which is NSE 100, although the volatility is only marginally higher. So typically what happens is that greed and fear, emotions drive investors into the market and out of the market, and typically investors end up exiting at the worst possible time and end up entering also at the worst possible time. So a hybrid approach, a balanced approach across 3 market caps reduces the volatility curve for the investor, reduces the heartburn that they can have. At the same time, the returns are fairly decent.
My next question to you is a blend of 2-3 questions put together. Now, against this backdrop, how does a multi-cap strategy give you the flexibility to respond to market dynamics? What's your overall approach to the portfolio construction? Top down, bottom up, or blended? What is your take on this?
So look, our portfolio construction approach is a blend of top down and bottom up. Typically, we identify the mega themes to bet on within the country. And we've been talking about a lot of the mega themes that are available in the country. We've identified about 8 to 10 mega themes.
Okay.
So we go across these themes, understand what is the structural compounding that the sector has to offer. And within that, we look at companies from a bottom-up perspective, companies which can probably outdo the sector growth. Typically, we look at sectors which can compound at 12 to 14%, slightly above nominal GDP. And there are a lot of companies which offer north of 15 to 20% top-line compounding. Earnings compounding can be higher. So our mantra is to identify such companies And then sort of we drill down into the dynamics of the business model, the promoter pedigree, the execution track record, corporate governance standards. So a lot of bottom-up approach that goes into identifying these companies. So look, we've figured out that sectors, stocks which can do fairly decent amount of compounding, which is early double digits to late double digits. We're finding these opportunities across different market caps. Typically, large caps won't give you very high compounding of the order of 25-30%, but they give you a decent 12 to 15% compounding in earnings, and you've got 100 large caps to pick from. Can we identify a pool of 15-20 large caps which can sort of grow at a decent clip? Yes, the opportunities are there. And the good thing is that valuations for large caps, because it has been a sector which has not given runaway returns over the last 3-4 years, the valuations for large caps are pretty okay. Like I said, the valuations are running at about 10-year mean levels. So opportunities to make money are there in large caps, and typically large caps are not highly volatile. Whenever we see bouts of significant volatility in the market, small caps tend to correct a lot. The beta on the downside and on the upside is significantly high. We've seen that in the last couple of months, specifically in Jan and Feb. Small caps and micro caps corrected significantly more than the large caps. So large caps give you that stability, right? And in moments of crisis, in moments of aggressive selling, sort of people naturally gravitate towards the most stable companies. Small caps have this excitement amongst them, right? Because they sort of tend to grow. They're undiscovered companies. So typically when the economy goes through a slowdown or a mini crisis or globally there are issues, people respond to saying that, look, I don't know whether this company is going to end up growing. There's too much promise, there's too much hype, and nobody knows about it. So people sort of automatically gravitate towards the safe havens. So that's why you need a bit of large caps, you need a bit of slightly larger mid caps as well in your portfolio. So interestingly, the multi-cap approach, like I said, gives you a blend, right, across minimum 25% mid cap, minimum 25% small cap, minimum 25% large cap. So 75% is done over there. The balance 25% is going to be completely bottom up. Wherever we find opportunities across different market caps, we go. So I think investor ends up getting smoothened returns.
I think that's well put together. And since you mentioned the word volatile, my next question is a very interesting one. How does one create an alpha volatile environment in a substantial basis? What's your take on that?
So good question. So let's understand what goes into creating alpha, whether volatile, non-volatile. I think the moot point is that how do we at Trust Mutual Fund sort of go about identifying winners for ourselves, right? The so-called gorilla stocks. So I think in the last 30, 40 years or even in the last 100 years, the playbook has remained fairly simple, right? So what is the playbook? Identify good quality companies, identify good promoters who are hungry to grow, identify a sector which has tremendous runway for growth. And we're looking for runway for the not next 3, 4, 5 years, but typically for the next 10 to 15 years. The longer, the better. So we follow a similar mantra. We've got this framework where we look at companies from an LIM approach. So which is leadership, intangibles, and mega trends. And sort of that fits into what we call as terminal value thought process or terminal value investing for identifying long-term winners. So let me just tell you quickly what this LIM framework talks about, right? L stands for leadership, right? In a nutshell, we're looking for managements which have this innate desire to sort of grow, right? They have this hunger at every step, no matter how big they've made it, but they still want to continue to sort of grow, compound their business. And these guys are interested to create wealth for themselves via the stock market route. So we as the minority investors would end up making money alongside them. So we look at that hunger, right? What is the passion? What is the desire? What is the kind of senior management team the promoters have built or the CEO has built? What is the execution track record? We witnessed in the last 25, 30 years, India doesn't get innovative business models, right? We are not the Silicon Valley. We are not China. More often than not, what matters in India to get good compounding is execution. Execution is underrated, and execution actually is the number one moat, I would say. You could do a plain vanilla copy-paste business of another business, but if you execute beautifully over the next 10, 15, 20 years, the outcomes could be materially different, right? So execution is the number one thing that we look at. What has been the historic execution, and can this management continue to deliver over the next few years? And obviously what matters is that how you've done it, ethically, what are your corporate governance standards, what sort of integrity has gone in creating the business, right? So this is the L part, the leadership. And I would say in investing, around 90% plus of your long-term returns, like I'm talking 10 plus years returns, are a function of the kind of management you end up backing, right? Nothing else matters. So that is the number one thing that we focus on. A lot of qualitative and quantitative assessment that goes into that. Second is, I would say, right, which is intangibles. So what we've noticed in the last, I would say, 15, 20 years, if you look around, some of the largest companies in the world today, right, Apple, Google, Facebook, Netflix, Tesla, some of these companies are fantastic brands. They've got fantastic software IP, or they've got fantastic managements running them. If you dial back to early 90s or late 80s, the largest companies in the world, or even in India, were companies with heavy fixed assets. So the world has changed a lot in the last 15 to 20 years. Value creation has happened a lot through intangibles. Could be brand equity, could be software IP. In a lot of these cases, the example I told you is about the software IP or brand equity. And none of these companies have ended up manufacturing what they make. Apple doesn't manufacture the Apple iPhone. It's all outsourced, right? But Apple, what they do is that design the software, they make the software, and they keep upgrading it. So that's the thing about these companies. Promoters need to understand how value creation is happening. So that's the intangibles part. The third aspect is the mega trends within L, I, and M. Mega trends is absolutely essential for investors to sort of get long-term compounding, right? If you are going against the tide, it will become very difficult for you to compound wealth. But if you are already in a tide which is sort of going to last for the next 5, 10, 15 years, you even back the 6th, 7th, 8th player within that mega trend, you will end up making money, right? For example, if you look at financial services in our country for the last 20 plus years, we've been in a wave. Credit growth in our country has grown at, between 1.3 to 1.8 times at times of nominal GDP. So that's lent itself to a lot of companies growing at 15, 20, 25% in some cases, and you've got fantastic compounding. IT services, where the offshoring boom started off in the early 2000s and has continued even now, that has lent itself to fantastic companies being created, and people have got multi-bagger returns out of these stocks, right? Large cap, mid cap, small cap. So you need to catch the wave. So at Trust Mutual Fund, we're looking at multiple mega themes, right? And identifying bottom up what companies to bet on. So I think alpha creation sustainably, be it volatile times, non-volatile times, is about sort of sticking to this mantra. So that's one thing. The other thing is that not very often you'll be able to figure out what's going to happen in the next 5, 10, 15 years, right? Because the world is very volatile.
Right.
It's very dynamic. Things keep changing. Technologies sort of move out. Companies can become obsolete in a span of 5, 7 years. You can have an alternate product which substitutes your entire need for the product you're making. So 70 to 80% of what we invest in is identifying companies which can sort of grow at a very fast clip over the next 2 to 3 years, right? And this is what we call as GARV framework, which is growth at reasonable valuations, wherein we look at companies across the market cap spectrum, across the valuation spectrum, and look at what their valuation is adjusted for the growth, right? Like the example I gave earlier, we would rather have a company which is trading at a PEG of between 1 to 1.5 than just to back an optically cheap company which is trading at 15 or 20 P, where the PEG could be significantly higher. So GARV framework is really where we invest majority of our time and energy, and majority of the portfolio construct is via that framework. So that is our mantra for generating alpha.
So Aakash, would you say that it is possible to identify long-term gorilla stocks early on? Do you think that's something that's possible?
Yes, It's been possible. It is quite possible now. It's been possible for the last many decades, and many investors have followed this strategy. So we've called it identifying gorilla stocks. Somebody else would identifying multi-baggers. The wordplay keeps changing, but essentially is identifying young emerging businesses, right, which have a fantastically high runway for growth, right? And typically we are looking at runways for the not the next 3 to 5 years, but 10, 15 years and even beyond. A lot of companies in mid cap or large cap or even mega cap, 15, 20 years back, they were small caps or micro caps, right? And they've gone on to become mid caps or large caps because of the fantastic earnings compounding. It's quite possible to identify them early on. And some of the things that I talked to you about in the previous question, looking at the LIM framework, leadership intangibles, mega trends, or looking at the mega trends in the sector. This is what we sort of look at. Typically, we want to look at these companies when they are just about to have that lift-off phase, right? The market caps of these companies are typically between, I would say, 2,000 crores to 15, 20,000 crores, where they are still relatively undiscovered. Not a lot of people have faith in the management's ability to go on and sort of create a, business which can sort of scale up. So that's where sort of you're going to have to kick the tires, go and understand the competitive dynamics, go and understand, what the promoter is actually doing, what is his capability, and it requires a lot of detailed groundwork analysis, right? Many a times, even before meeting the promoter, we end up doing a lot of channel checks to understand what the promoter is doing, what are his interest levels, what is his ambition, things like that. So I think the small cap universe still offers a lot of opportunities to create these sort of gorilla stocks. India has always offered bull market, bear market, euphoric market, sideways market. Always is a party going on somewhere. We need to focus on sort of that part of the market.
I think that's well put, and it would be great if you could walk us through how your stock selection differs across large, mid, and small caps, and what nuances do you factor in for each segment?
So, the stock selection strategy broadly remains the same. Looking at earnings compounding, looking at management pedigree, looking at tailwinds in the sector. Typically, what happens in the large cap universe, you don't get to see companies which are growing at a very fast clip. By fast, I mean north of 15-20% on a sustainable basis. So the large cap universe offers us sort of early double digits, mid double digits earnings compounding. From time to time, valuations become euphoric and sort of, so you need to sort of take a valuation call sometimes. But typically, large caps give us that stability, right? So if you see, look at our portfolios, for example, the flexi cap offering that we have, large caps have formed between 40 to 50% of our allocation over the last, I would say, 12 months or so. So it's not that we are not finding opportunities in small cap, in large cap. Mid and small caps is sort of more about, like I said, kicking the tires, understanding ground up what's happening. You could have a sector, which is euphoric, but sort of more often than not, for example, I'll tell you, defense and capital markets, case in point. A lot of stocks have given multi-bagger returns in the last 3 years, right? And more often than not, people sort of brush it on the side and say, look, a lot of money has been made, there's a lot of euphoria. So that's when our thought process comes in, and the way we think through this is that, look, a lot of money has been made, yes, the sector is in euphoria, but can this sector deliver fairly high earnings growth in the next 5 to 10 years?
Right.
What people forget, right, is this, what happens in stocks, in valuations, the valuation science, 70 to 80% of the value of companies in high growth stocks is derived from what they will do beyond the first 5 years. So sitting in 2025, the earnings growth of the next 3 to 5 years matters only to the extent of 20 to 30%. And we as investors are obsessed about the here and now. What is going to happen this quarter? What is going to happen next quarter or the next year? And lo and behold, 80% of what will happen in the valuation is what will happen after 5 years. So, and people forget that, right? So there is a small set of investors, maybe 1 to 2% of investors who have consistently done well over the last 15, 20 years, they understand drivers of valuation and they sort of tend to focus on the big picture, on the longer term. So it's very essential not to lose focus of that. And mid and small caps, because they are high growth, and from time to time you'll get valuation exuberances. But it's important not to sort of get sucked into that and have an eye on the longer term.
When it comes to managing downside risk, especially in the mid and small cap space, what's your framework for protecting an investor's capital during this volatility?
So the one good thing that we do at Trust AMC is that we run fairly diversified funds. All right. So if you look at the FlexiCap offering that we have, over the last 12 months, average, we've been having about 60 odd stocks. And we've said publicly to investors that between 50 to 60 stocks, give or take, will be the allocation. Even in the small cap offering that we have, on an average, we'll be having about 60 stocks. So inherently, by having a highly diversified fund, and typically these are benchmarked, the FlexiCap is benchmarked to NSE 500, the small cap fund is benchmarked to the small cap 250. So the benchmark itself is so diversified. In spite of benchmark having, say, 500 stocks or 250 stocks, is delivered fantastic compounding over the last 3 years, 5 years, 10 years. So concentration is something that is not what we believe in. So automatically sort of having a diversified portfolio allows the investor to sort of not have the whipsaws that small and mid cap can have. So downside is protected to that extent. In small cap and mid cap stocks, we typically don't have allocations more than 2 to 4%, right? So that's one thing that we do. So automatically, again, the concentration risk is controlled at the fund level. If it's a large cap stock, then we could go to even a 7, 8 or 9%, depending upon what the allocation is within the benchmark. So that's one thing. The other thing is that we don't look at highly illiquid stocks.
Okay.
Typically in our country, when you go below 2,000 crore market cap, the liquidity for large investors is fairly low, and you may get in, but getting out becomes very tough. It could take 2 months, 3 months, sometimes in some cases even 1 year to sort of get out of some of these highly illiquid stocks. So sort of we control that. Typically our bets are more often than not above the 2,000 crore threshold. The average market cap of our small cap fund, for example, is in the vicinity of 25,000 crores, right? So we are not betting on micro caps or small caps, right? So the liquidity is controlled. The drawdowns are controlled with that portfolio allocation strategy. But markets being markets, they'll keep giving you whipsaws, right? No matter what you do, you still have, like we witnessed in the month of Jan, Feb, stocks went down 40, 50, 60%. What do you do, right? And more often than not, there are no fundamental reasons you can find. It's just that there's a broad-based sell-off, and small caps sell off way more than sort of what they should. So ideally, you want to be acting counterintuitive at such points in time, right? When there is a sell-off for no random reasons, no fundamental reasons, you want to be buying, and you want to be selling sort of when there is too much euphoria. But that's easier said than done in a sort of fund construct. Sometimes you need to sort of actively sort of balance risk and sort of sometimes get out of positions where you know that technically things may not be moving in the right direction, could be moving against you. So we are happy to sort of get in our risk management framework in place and sort of get out of few stocks if we may be in this sort of downward trajectory, the stock may be in a downward trajectory. So that's what we do from time to time to protect the volatility in our funds.
So speaking about liquidity and risk as a key concern for mid and small caps, how do you manage this, especially during periods of market stress?
I mean, look, if the markets are falling 30, 40%, everybody falls, everybody takes a knock. It's sometimes when stocks fall for no random reasons, you don't know the reasons, and the reasons come to the fore only after a few months, right? Maybe the promoter wants to sell, maybe there's an impending M&A happening, maybe a new competitor wants to get in, you may not know the reasons then. So our risk management framework kicks in and we say that, look, these reasons are beyond what we comprehend right now, and it's better to sort of stay out of this or not participate in this story for now until the dust settles. So that's how we sort of mitigate the whipsaws that you get in small caps and mid caps. And like I said previously, we run fairly diversified funds, right? And no stock will have an allocation, no mid or small cap stock will have an allocation beyond 4%. So even the volatility is controlled at that level.
How actively do you anticipate rebalancing this portfolio across market caps?
So I assume you're talking about the multi-cap strategy, which we are offering, which we're getting onto board right now. So look, I think minimum 25% has to be invested by mandate, which is what we have guideline. So that way, the rebalancing across market caps is mitigated to a large extent, right? In a flexi cap, you could sort of go overboard large cap at a certain point in time. And if you see, look at the industry today, almost 60% of the flexi cap funds have invested in large cap. If you dial back about 12 to 15 months back, that number was nearing 70%. So people sort of ignored the mid and small cap part of the market in the last 12, 15 months, specifically in flexi cap. And they've suffered, because of that, because small caps have offered fantastic compounding, like I said. And this fund, the multi-cap strategy, by mandate gives you 25, 25, 25, right? So the rebalancing is not required to that extent. It's just the fund manager or the fund management team looks at the best ideas across each market cap. And then the balance 25% is really a bottom up. So I think the way I'm looking at the market construct right now, between 25 to 30% would be mid cap, between say 30 to 35% could be small caps, and the balance would be large caps. And we'll see how the time progresses and where we get valuation anomalies on a short-term basis.
So, Aakash, can you tell us that are there some sectors that you're currently bullish on?
There are multiple sectors that we are currently bullish on. So if you look at our two portfolios, flexi cap and small cap, over the last couple of months, we've been extremely bullish on industrials as a sector, which has various subsectors. So within industrials, primarily we have taken an outsized bet towards defense stocks. We've seen that over the last couple of years, defense expenditure has gone up meaningfully. Defense exports has become a viable alternative right now for India. We started off in 2016-17. Defense exports have picked up meaningfully. And there are multiple stocks within the defense sector which have different sort of tailwinds going on. Something could be missiles, some things could be defense electronics, something could be shipbuilding. So there are multiple sub-themes within that. So defense is a big exposure for us. Also within industrials, we've taken exposure towards a lot of the export-oriented themes. So it could be manufacturing, could be sort of the power sector, wherein we are seeing a lot of tailwinds coming about in the power T&D sector. This is part of the energy transition theme that India is sort of underway, where India is investing aggressively to move from fossil fuel generation to renewable generation, where a lot of capacities in wind and solar are being put up. So there are multiple stocks within that we've taken exposure towards. So industrials is one. The second big exposure that we've taken and overweight exposure is financial services. Within financial services, there are three main buckets that we've sort of taken exposure to. One is capital markets, and we've talked about this during some of the previous questions, where we've been extremely bullish on the entire capital market ecosystem for the last 1 year or so. So that's one theme. The second theme is NBFCs. We've been bullish on that for a while, but now of late we've seen that with the interest rate cuts that the RBI has instituted in the last, I would say 2 to 3 months, cumulatively 100 basis points have been cut. So earnings of NBFCs could get a fillip because of that. And anyway, some of the NBFCs that we have sort of taken exposure to, they were growing at a fairly healthy clip of 20% give or take. And I think now their earnings can end up growing faster over the next 1 to 2 years. So NBFCs is one. The third bucket within financials is banks. And we've got some of the leading private sector banks that we've taken exposure to. And these guys are compounding at a fairly healthy clip of 10-12%. They don't compound at 20-25%. Gone are those days. So you get an outcome of early double digits, mid double digits from the leading private sector banks is a fairly good outcome. So financials is the second big sector. Then after that, there are a bunch of smaller sectors. So for example, we are fairly bullish on healthcare. So we've taken exposure to a couple of hospitals across the two funds that we have. We have been bullish on the diagnostic space off and on, but we like that as a structural opportunity in India. And then we have multiple smaller sectors, for example, discretionary consumption. Within that, we are extremely bullish on retail, apparel, we're bullish on premium consumption within that. Automobiles, SUVs, passenger cars, high-end two-wheelers. So these are the kind of sectors that we've taken disproportionate exposure towards. Yeah.
I think that's very well explained. And there's one thing that I really appreciate about this conversation is the fact that things are explained in such a simple manner that even a person from a non-finance background would be able to understand it pretty well. My last question to you before we wrap up, I want to know your outlook for Indian equities over the next 12 to 18 months, and how is your fund positioned for that journey?
So if you look at the last year or so, right, we've gone through quite a lot. There's been a lot of noise, both domestically and internationally. So India has taken a lot of these negative points, and markets have digested a lot of things. We're only about 5 to 8% away from life highs currently. So the backdrop for an incoming investor today is fairly good as compared to what it was 1 year back. We've seen a time correction. Returns across large, mid and small cap indices over the last 1 year have been low single digit. After a rip-roaring rally of 2022, 23, 24, 3 years, sort of we did fairly well. So we've taken this time correction. And we've seen that markets returns follow earnings, right? Wherever the earnings compounding is fairly solid, people will sort of gravitate their capital towards there. The problem with India over the last 6 to 8 months was that earnings were consistently getting downgraded. So people's expectations were sky high at the beginning of financial year 2025, and by the end of financial year, expectations have been revised downwards significantly. So we've gone through the peak of the earnings down cycle, and in the latest quarterly earnings, we've seen that there were more earnings upgrades than downgrades. Right, so 56% of the BSE 200 companies had consensus beats, right, and this was a 16-quarter high. For the last 2 quarters, quarter 2 and quarter 3 of F25, that number was in the vicinity of 35 to 40%. So 56% earnings beats is a fairly good outcome, and we think that the earnings down cycle is largely behind us. Next 12 to 18 months or 12 to 24 months offers compounding of the order of early double digits. So investors need to sort of temper their expectations, I would say. So getting 10 to 15% give or take returns over the next 2 year standpoint is something that one can look at, that moves in sync with earnings. But again, at a stock specific, at a mid and small cap specific level, the earnings compounding is potentially much higher, and the return expectations or the return outcomes, I think, could be better over there if you give it time. So I think it's a good construct for a new fund, for an incoming investor. We are past all the euphoria. Expectations have been tempered, like I said. India is on a cyclical upturn. A lot of the issues that plagued the growth that we had a couple of months back are behind us. India has always been an oasis in the multitude of issues that is plaguing the world. We've unfortunately seen the kind of tensions that have emerged on the border also, and India emerged victorious over there. So markets have taken multiple things in their stride, and the government and both the government and the RBI has sort of turned pro growth now. They tightened quite a bit last calendar year, and now sort of they are moving to the other side where monetary policy is being loosened. Interest rates have been cut. Liquidity has been infused over the last couple of months. Even the government capex is back meaningfully, and FY26 will be a more normalized year where capex grows at about 10-12%. Last year was a big sort of up and down where 8-9 months we had negative growth, and then growth only picked up towards the end of the financial year. So I think we're looking at more normalized growth in FY26, and the construct going into the next, I would say, 2 to 3 quarters is that the year-over-year base for earnings is very depressed because last 6 months not a lot happened in the economy. Our GDP growth had plummeted to 5.4, 5.5 because of government armory sort of not being there because they were busy in general elections and multiple state elections. So all those factors are not there anymore, right? So you could get to see fairly good earnings going into FY26, and expectations have been reset. markets always work on expectation versus reality sort of, and the dispersion between that. So it's a good space to be in for an incoming investor.
So that was a very insightful conversation, and thank you so much for your time. And it was a pleasure having you here today. Thank you so much.
Thank you, Alisha, for having me. I had a wonderful discussion.
Thank you so much.
I hope your viewers enjoyed as well.
Thank you so much. The pleasure is all ours. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.